Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. We saw US inflation data out, and as everyone expected, it was a better number, and it's encouraging to think that US inflation has in fact peaked. I tend to think that is the case. The problem is, it's still spectacularly, terribly high. And I think people just think it's some kind of abstract number, but high inflation means the underpinnings of the US economy are being steadily eaten away. And it's not a good thing. So the longer this goes on with these high inflationary levels, the longer, and I'm talking in terms of years here, it will take the US economy to fully recover to trend growth. So we're looking at below trend growth for the US economy for as far as the eye can see. This is why the Fed's trying to bring immediate pain, in fact, it wants a slowing of the economy. So it's not so much that it doesn't mind if the economy slows to fight inflation, it actually sees that as the way of fighting inflation. So we're going to have a below trend, in fact, probably negative 2023 ahead of us. Remember, in 2022, the US economy has only grown by 0.4% in the first 9 months. So going forward, I think it's not a big call to suggest that 9 months of 2023 may in fact be negative. In fact, it could be all year long, as the Fed's interest rate hikes to date still have a lead time of 6 to 18 months in terms of their full impact on the economy. The Fed is going to continue to hike rates, even if it's only 50 points tonight. By the way, if you didn't hear, the inflation figure was 7.1%. Or near there yesterday, it doesn't really matter. It was just that it's a much better number. But also within that inflation number, services were strong, and we're expecting very strong housing costs to rise steadily over the coming year. So inflation isn't over, it's still a battle. And expect Chairman Powell to say pretty much that in his comments after the Fed raises interest rates by 50 points tonight. Now, that won't be as quick as 75, and there is a small chance there could be one more 75-point rate hike, but even at 50 points, and this is what people need to realize, even at 25 points, that's further restriction on the economy. At 50 points, we're still in the aggressive interest rate environment, hiking environment, and so see it for what it is. That is an already on its knees US economy, with the Federal Reserve continuing to hike interest rates and cause severe mortgage stress as we move forward, on top of the higher prices that consumers are having to withstand. Now remember, this is year-on-year inflation that's peaked. Prices are continuing to rise. So it's getting more and more difficult for the US consumer to cope with the cost of living. It's not suddenly easier for the US consumer. It's not like their wages rose by 8-9% over the last 12 months so they can absorb these higher prices. It's that the rate of increase isn't continuing, but prices are still going up. The burden on the consumer is still going up. And as I said, we're going to see a lot coming through from input prices, which has not yet reached consumer prices. We are in a wages inflation spiral in the United States. I called that many months ago, and now a lot of other mainstream commentators are joining us, as they always do, rather late in the game. And so we have to understand inflation will be seen by the Federal Reserve as still a very serious concern, to which it will continue to raise interest rates. How much higher? Perhaps another 2, 3, 4 meetings and then a pause, at least 2 or 3 50-point hikes from here. So that means a US economy being driven into the ground. That means earnings continuing to be reduced. So be careful on that earnings front. And always when you're looking at earnings, remember that the boards of directors who set the earnings forecast, they lowball it, so it always looks like they exceeded expectations. So if they expect earnings to be $1 a share, they'll say, oh, it's probably going to be 85. And then when it comes in $1, they go, oh, look, we vastly exceeded expectations. So just be aware that earnings are in trouble in the United States. The US economy is in trouble. Inflation may have peaked in the year-on-year rate, but prices do continue to move higher, which is why yesterday the US stock market did exactly what it should. Wasn't it nice to make money on the way up and make money on the way down on the same day? Because as I suggested, the market followed exactly its recent playbook, which is to get falsely excited about a slowing inflation, only then to remember that interest rates are going to be going up aggressively anyway, and the US economy is in a dire state. So that's what happened yesterday. We could see a mini version of that today, but I just want to highlight to you that the dominant risk is very much to the downside. So watch out for that in stocks, maybe a bit of a bounce. Overall though, dominant risk down, lower. Probably we could say we were wrong if yesterday's highs were exceeded. They don't look like being exceeded. So we'll see what happens. But I would suggest continued extreme caution, playing defense on equities and most of your investment portfolio as interest rates around the world continue to skyrocket. Have a great day. Clifford Bennett, Chief Economist, ACY Securities.